Lack of funds stops most people from investing in real estate. Today, I'll kill that excuse. On this video, I'm going to show you 5 ways that you can invest in real estate without any of your own money. They include private money, hard money, seller financing, creative subject to financing, and partnerships. Money is everywhere if you solve investors' problems. The first one I'm going to talk about is private money. Private money is like friends and family money. This is some of the cheapest money that you could possibly get, and it's also the most flexible. What you need to do is you need to look for investors that are looking for an opportunity. If the stock market is crashing or going up and down, it's crazy. Bitcoin might be going up and down. People are frustrated with wherever they're investing their money, and they're looking for something solid to invest in, like real estate. If you look for those people, they're online, they're on YouTube right here, they're on Facebook, on Instagram, they're in your phone, they're in your email list. They might be frustrated with where they're investing their money, and not necessarily just looking for better returns, but looking for something consistent. You don't have to give away the farm when it comes to private money. You can offer something like 4 to 8%. What I like to do is I like to ask the investor what they want to earn on their money. And so if they're earning 4 or 5% right now, they might be interested in 6 or 7. If they're earning 7 or 8, they might be interested in 9 or 10. So I'm gonna adjust based on the investor, not based on the deal. That's very different than what most people teach. Most people say they're gonna give away double-digit returns. I don't do that. I like to make it a custom suit. I like to ask them what they want and then give them what I'm capable of giving them. So if they want 9% and I can afford that, great. If they're asking for 15% and I can't afford it, I might say, I can't do 15, but I probably could do 10% on this deal. And if it's a win-win, they're gonna say yes. It has to be a win-win. Private money is amazing. It's the most flexible money out there, and it's right in your backyard. So private money is my favorite one of these 5. Private money is the tool that I've used to scale my business and raise over $150 million. In the description, I'm gonna give you my script for raising private money. So make sure that you check that out and you grab it. It's totally free. All right, next is hard money. Hard money is usually a large company that's designed to fund fix and flip type properties or even rentals on a DSCR loan. And the fix and flip properties they're used to lending to are usually below market value, so you're buying them cheaper, and they're gonna fund the majority of it, maybe 90% of the purchase, or even up to 100% of the purchase and all the rehab costs. And so what you're doing is you're submitting your deal to a company to underwrite it and see if it's a good deal. If it is, they'll finance it. It's usually a little bit higher interest. There's points, there's fees, and the interest rate might be somewhere between 8 and 15%, but they're gonna give you the money quick. Where the difference with hard money and private money is you might have to nurture the private money lenders for a little bit, but when it comes to hard money, it's either gonna be a yes or a no. They also fund brand new flippers. So hard money can be a great option, especially as you start scaling your business or when you're just starting out and you don't have a lot of private money lenders. My favorite combination though is a combination of private money and hard money. I used that to scale my business for many, many years to get to the point where we were doing almost 200 deals a year. If you want me to teach you guys how I did that, let me know in the comments, I'll make a video on it. All right, if you're still short on the down payment or don't have any private money or hard money lenders, let's get the sellers to fund the deal. Sometimes the seller is the bank. Many people don't know this, but the seller can actually carry a mortgage back if they have a paid off house. A lot of times I deal with older people whose house is completely paid off and they don't know what to do with the money. They don't want to put it in the stock market. It's just going to go in their bank account if I buy the house. So I can actually pay them a little bit more, potentially, and let them carry the mortgage themselves. So what I mean by that is they become the bank. Just like Wells Fargo or Bank of America, they put a mortgage on their own house. They sell it to me, and then they carry the mortgage based on whatever interest rate and whatever terms that works for both of us. So an example is I could have the seller carry the entire purchase price of the house on an interest-only payment for the next 12 months at, say, 8%. So the seller loves it because they can sell their house, get out from under it, they can make more money, make 8% every single month than they would in the stock market or somewhere else that they were gonna put it, like a bank account making 0.1% interest. And I get a house that I didn't have to come up with the money for. Now, I might have to go find the money to fix it up or do something else that I want to do with it, but the seller carries the mortgage. It's a great strategy, especially if the house is paid off and the seller doesn't know what they're going to do with their money. You could even give them maybe $50,000 and have them seller carry the rest. So another way to do this is to have the seller carry the mortgage. Now, if there's a mortgage on the house, we can still do some creative financing like that. What we can do is something called subject to the existing mortgage. So what that is if the seller doesn't care that the mortgage gets paid off right away, you can ask them if they mind the bank waiting to get their money. So let's say I'm buying a house for $200,000 and the seller has a $150,000 mortgage on it at 5% interest. I can actually buy that house at $200,000. I only need to come up with $50,000 to give to them, and then I can continue to pay their mortgage at $150,000 at 5%. So I'll just keep making their mortgage payments, especially if I'm fixing and flipping it. Then I can just come up with the down payment to the seller, 50 grand, and the renovation costs. Bank of America keeps getting their money, so they don't care. That's creative financing called subject to the existing mortgage. All right, now that I've shown you 4 of these strategies, let me combine a couple of them so I can show you how creative you can get and how you literally need no money out of your pocket to flip a house. On that last example, we have a $200,000 house that I'm buying, $150,000 mortgage on it. Well, I can do an owner carry for the $50,000 if the seller doesn't need it, and they get monthly payments. I can take the $150,000 over subject to the existing mortgage and pay Bank of America or Wells Fargo that monthly payment. And I can raise the rehab costs and all the carrying costs with private money. I could have no money in that deal, fix and flip a house, take all the profit, and have an amazing, amazing deal. This is how you can use these financing strategies and not have any money out of your own pocket. All right, if none of these 4 work with you, another option is you could partner and split the profit. Here's the structure. 50% of something beats 100% of nothing. And so if you can find a money partner that's gonna come in and you're gonna do all the work and they're just gonna finance the project, you can actually split the profit in something called a joint venture. This is actually what I did when I got started. What we did was I found somebody who had a bunch of money, but he lived in California and I was in Florida, and he would fund all of my fix and flips. I would find the deal, I would negotiate the deal, I would work with the contractor, I would handle everything. I'd put it on the market, work with the realtor, we'd sell it, and then we would split the profits 50-50. He was happy because he didn't have to do any work, he just put in the money. I was happy because I didn't have to come up with any of the money, so I jumped right into an equity partnership like this. I didn't form an entity, an LLC with him. I would highly recommend you don't do that. You just do it on a joint venture agreement. So we created this agreement, he had his LLC and I had mine, and we created a joint venture agreement that talked about what he would do and what I would do, and then it would split all the profits 50-50. It doesn't have to be 50-50, that just happened to be what I did. I think that the work that you do, finding the deal, negotiating the deal, running the contractors, managing the project is worth way more than 50%. I think the money is worth less, but at the time, I didn't know any better. So I've made hundreds of thousands of dollars doing joint ventures like this, and it's a great way to get your feet wet if you know somebody with money that doesn't want to do the work and you're willing to put in the work. So equity partnerships can be a great option for you if that's the case. But if you keep following me and you subscribe right here, I'm gonna teach you lots of ways to find money for deals so you don't have to give up 50% of your profits. So make sure that you subscribe, hit the bell, leave something in the comments if you have another video that you want me to make, and I'll make sure to do that. Now that you found the money, on the next video, I'm gonna show you 3 different ways to find off-market deals that nobody else will ever see.